Top three things in my notebook this morning. Number one, the US dollar. Number two, the bond market. And number three, gold. I could throw the Alibaba in there. I should have done that. I'll go with the dollar first. So the dollar after the central planning day hits its crescendo, and everyone's looking now at the Europeans printing more and more monies, or at least attempting to tell you that they're going to do some version of that, which is of course incongruent with what's actually happening in the European economy, which is slowing. So again, the bull case in Europe is that the euro's down. That's interesting. But again, I think the bull case actually in Europe, if everyone is honest about it, is that Draghi's drugs are going to save the asset side of the market, which is, of course, a very interesting paradox to Christian Drake's point. So again, U.S. dollar signaled immediate term trade overbought into the belly yesterday. We put that number, or at least that signal, up on real-time alerts. So again, just a massive exhaustion signal that was obviously led by the Europeans. And again, the follow-through to the 10-year bond yield, which is just to hit on where we are at next. Again, we're testing this 261, 262 level. A lot of people trying to talk their book on the dots. Now, don't forget that their books are underwater for the year to date. If you've been short of bonds throughout the year or bullish on interest rates, you're fighting and fighting and fighting. A lot of people were fighting for this removal of the considerable time clause. That did not happen. People were looking for Janet to get more hawkish. That did not happen. So again, you're up here meandering. You're at another lower high. The 10-year bond yield, by the way, would have to go up another 20 basis points to get me interested from a trend perspective. So again, the trend is your friend on the long side of the bond market. On down days, you're only going to get so many more. Buy bonds, please, and or buy anything that looks like a bond, which includes utilities, which is our favorite sector currently, which is up over 13% for the year to date. Now, finally, on gold, again, gold doesn't like it when the dollar goes up and rates don't go down. You know that. I know that. We only know that because history told you that. So again, gold should look its worst right before the 10-year bond yield starts to go down and the dollar goes down in kind. Right before, like 2 seconds before. So if you're looking for that in the dots, you're probably not going to get that in the dots. And again, I don't play with my dots too often either. I can't believe I just said that. Those are your top three things.